Thanks all for joining. Today I'll talk a little bit about an introduction to cross-exchange market making. And this is a strategy that generated, for me at least, some predictable income and consistent returns regardless of what market conditions are as a semi-passive income stream. And especially the last part is quite important for me as I'm still a student. I don't have time to sit in front of the charts all day. I need to be studying, even though a lot of times that actually is not the case. And I'm spending more time in front of the charts than I actually want. I have to say, of course, this is not financial advice, and everything that I say here is based on my experience. And, of course, other traders might view it differently. And I would definitely recommend people to start experimenting and see what works for them, and don't take whatever I say as the truth and it should be this way. So that being said, we're going to talk a little bit about the basic concept again, then the inner workings of how does it work behind the screen in the code. Then some parameters, how do you set them, picking markets. And I think these are the two most important things of today, like how do you pick the right markets and how do you set up the bot. But of course, also important to understand how does it work. Then the main risks, scaling possibilities, then we'll end up with the pros and cons of cross-exchange market making. And in the end, I'll be posting an improvement proposal later this week or next week. And I would like to briefly talk about that before we end the session. By the way, if you have any questions, feel free to just jump in so we keep it a little bit, dynamic. And of course, in the end, there are some possibilities for some questions as well. A little bit about me before we start with the things that we're actually here for. So my name is Jelle. I'm 25 years old, studying digital market analytics and data science at the moment in Groningen, a small little place. Of course, I'm from Holland, so of course, I'm a little picture of the tulips and me and my girlfriend. I'm a 1.5-year-old crypto rookie. I don't know if you can still call it a rookie, but compared to some other people in the field, I think it's still called a rookie. And I've been trading with Hummingbot for a little bit over a year now, and it's been going quite well. I'm really happy that I found it. When I made some money in crypto 1.5 years ago, I started off with looking for ways to make my money work for me, and found some arbitrage bots and all these kind of like automated things. You set and forget, you put money and you get money out, but a lot of things didn't really seem to work. And what I really love about Hummingbot is that I'm in control of what's really happening. I know all the risks, and I know how I can increase my risk and decrease my risk to my liking. So I'm okay, scaling up because I know how it works and what the risks are. Compared to other automated strategies, it's really hard to really know what's working behind the scenes or under the hood. You know what I mean? So I'm really happy I found this. So the basic concept of cross-exchange market making is to trade when there's a direct economic opportunity to buy low and sell high. So you're not concerned about market price or risk, while earning liquidity mining rewards and increase market efficiency. And this direct economic opportunity is mostly created by a difference in spread between a taker market, generally a market with a tighter spread, and a maker market, generally the market with a wider spread. And as you're buying low and selling high, theoretically all the time, you're effectively trading delta neutral, which means that you're not increasing your position as the price goes up or down or the other way around. So cross-exchange market making, the basic concept. So before we start off, this is a pretty important chart to look at before we continue, because I will use this more often to illustrate how specific things work within cross-exchange market making. So for this case, you have two exchanges, a taker exchange, generally with a tighter spread, with a top taker ask of $110.10 and a top taker bid of $99.9. And you have your maker exchange, generally the exchange with a wider spread here, with a top maker ask of $100.50 and a top maker bid here. And what you generally do within cross-exchange market making, the bot observes every tick size, so generally every second, what is the price that I can directly sell or buy my asset at on the taker exchange. And for this case, we don't take into account order book depth, etc. If you want to directly sell your asset on the taker exchange, the exchange with a smaller spread, you can do that at a best possible bid price. And the opposite, if you want to buy, you can do this at a top taker ask, the best possible asks available. And as it knows that, you define a specific profitability level away. So what it does, it knows it can buy an asset at $100.10. You want to capture a profit of, let's say, 0.5%. So will place the order, a specific profitability target away from where it can buy the asset at. And what it does is once this order is filled, this maker order, let's say your sell order, it will directly buy back the asset on the second exchange, the taker exchange. And the opposite, of course, works for placing buy orders. It knows it can sell the asset for this price. It will place a maker order 0.5% away from that price. If this order gets filled because of whatever reason, people are buying or selling, it directly hatches the order by placing a taker sell order on this exchange. That's the basic concept. Compared to pure market making or an evaluator strategy, I think the big difference is that you don't really have a second exchange where you do anything with. For pure market making, you're mainly market making on one exchange. And the profit that you capture is the difference between two maker prices, which is also called the spread. While for cross-exchange market making, it's generally a maker to taker difference. Here, what you see is the profit is the difference between the top maker ask and the top maker bid, while the profit here is the difference between the two spreads on the maker and the taker exchange. So that's generally what happens. One more thing about this is like you also see that in generally the profit on a pure market making, if you make two trades, a buy and a sell trade without the price moving in between, is generally higher. But the biggest benefit you have with cross-exchange market making is that these trades are happening like instantaneously, like there's a split second in between. While for pure market making, it could be that your sell order is filled, but then like 5 minutes later, while the price has already moved, your buy order is filled, and you're making an unprofitable trade. Cross-exchange market making is kind of like a combination between like pure market making as you're placing maker orders on one exchange, and I would say like an arbitrage strategy. But the big difference between an arbitrage strategy and cross-exchange market making is that for arbitrage, you're capturing a profit, which is a direct, is a taker to taker profit. So what happens once two prices dislocate from each other in a way that you can place two taker orders and capture a profit. So what in this case happens is you have one exchange here. You can buy the asset for the top taker ask on that exchange, and you have your second exchange. And once these prices diverge from each other in a way that you can buy an asset lower and sell an asset higher, there will be a profit. But this profit only happens when two taker prices diverge from each other. While for cross-exchange market making, you're profiting from a maker to a taker order. So prices don't have to fully dislocate. It can only be a little bit, and you're mainly profiting from the difference in spread. I would also say that for cross-exchange market making, you're forcing a arbitrage trade by placing these maker orders on the exchange. While for arbitrage strategies, this opportunity just exists at one point and you can capture it. While for cross-exchange market making, you're forcing this arbitrage opportunity to be there by placing maker orders on the exchange. So, and for a perfect strategy, this is something what it would look like. This is the output of the history for both function on the Hummingbot terminal. And what you will see here is my maker exchange is Loopring, LRC USDC, and my taker exchange is the Binance one, the one with the tighter spread than on Loopring. And this is the LRC USDT. In this case, it doesn't matter if you do USDC or USDT, as long as you don't do USDC and UST, because UST is worthless at this point. And what you see here, I buy low and I sell high. You see there's a difference. And on the other side, I do it again, buy low, sell high. And here is where I sell high and buy low. And these are like split seconds in between. Maybe this looks like a second, but it might be milliseconds. And what you also see is that the order sizes are the same, which means that I don't increase or decrease my position. Sometimes there's a little bit of difference. That's because you pay some fees, but that shouldn't make that much of a difference. So this is what like the perfect strategy would look like. And like I said, this is mostly instantaneously. And what I've found is that by observing the charts and plotting where trades actually happen, this is, I think, the output for one of my maker exchanges. I tend to see that when there's a lot of volatility in the markets, I see that trades happen, which is obvious, of course, because those are periods where spread generally widens, but also that you generally trade at key reversal areas like bottoms or peaks. And then you generally do the opposite. So at peaks, you would buy on the maker exchange, and at bottoms, you would generally sell on the maker exchange. And therefore, execution is really important, because let's say you're on the bottom and you just sold your assets at a low, and you need to buy it back on the taker exchange, and for some reason this was not possible because the price already went up, you just sold your assets at the bottom and you need to buy it back higher. So if execution is not perfect, you're increasing or decreasing your position size opposite to what the market is actually doing. So there are 3 processes that mainly take place within under the hood. 2 of them happen at every tick size, so generally 1 second, and 1 other is only activated once there's an order fill on the make. So the 2 processes is a cancel order flow and a create order flow. So when does it create a new order, and how does it determine the price and the size, and when does it cancel the order? Let's first go into when it actually creates an order and how that works. There's a lot of text on here, and I think this one is recorded. Advise to maybe go back to this slide again later and see if you better understand it. Also, there's some good documentation about this slide as well on the Hummingbot Foundation website, which I advise you to read at least. So what it will do, every tick size, it will check whether there's already an active bid or an active ask. Let's say you're just starting the bot, so there's no active bid or ask. Then it will check if there's a profitable bid possible, which is most of the time yes. And then this is, I think, the most important one to understand. It will calculate the order size and it will calculate the order price, the maker price at which it will place an order. And these things depend on a couple of things. For example, the maker price is dependent on the taker price. So at every tick, it will observe at what price can I buy or sell an asset at instantaneously, like I showed you in the previous example. It will observe it every time. And this is called the effective hedging price. At what price can I buy or sell an asset at right away without any latency? And of course, it's dependent on order size. As you could imagine, is like if you place an order of $1 million, your effective hedging price is less beneficial due to slippage than if you place an order which is only $10. So order size is really important for this. Once it has observed that effective hedging price and it knows at what price it can buy and sell, it will add a minimal profitability level to that price, and that will be your maker price initially. And then there's another factor which is important, is your top depth tolerance. Which works just like the optimization for the pure market making strategy, which leaves out like some dust orders on the order book. So you can maintain like the top spot except for a specific amount of orders. So most important thing is it will calculate the effective hedging price and then adds the minimal profitability level to it. And that determines your maker price. And then your order size depends on a couple of things as well. First of all, your taker price, your effective hedging price, which you just calculated, and your maker price. And then second, like how much available balance do you have on the taker exchange, base and quote asset, and how much do you have on your maker exchange? Because for cross-exchange market making, you need to have balance on both exchanges. So let's say you're market making on one exchange for AVAX USDT on Gate.io, and you're hedging it on your taker exchange on Binance AVAX USDT. If you hold AVAX on Binance on Gate.io, you will own and only USDT on Binance. That means you will only be placing sell orders on the maker exchange. If it's the opposite, if you're only holding AVAX tokens on Gate and only USDT on Binance, that means you'll only be placing buy orders, because if it buys on the maker exchange, it is able to sell on the taker exchange where you have your AVAX. And then you have placed your order, and then it will also observe like when should I actually cancel my order. And that will be done every tick as well. So first you have a variable which is the active order canceling, if it's on or off. I always have this, I always have it on, the active order canceling. I've never done it without, because otherwise you can also, I think, make unprofitable trades when I'm not really sure about it. First we'll observe like if hedging is still profitable. It will observe the taker price again, the effective hedging price. At what price can I buy or sell the asset at on the taker exchange? And does it meet my minimal profitability criteria? So does it still meet my 0.5% profitability that I specified in the configurations? If that's not the case, I will cancel my order and create a new one, because I need at least 0.5% profit based on my parameters. Then it will also check, is there still sufficient balance on the exchange, on the taker exchange? So if my buy order gets filled, am I able to sell, the asset on the taker exchange? Is there still enough available balance? And then lastly, there's another variable like correct price. And what this one does is what you can imagine is like if you place a maker sell order on your maker exchange and the price moves down, but your maker order stays here, you're actually better off canceling this order and replacing a new one lower, so you hold a better position in the order. That increases your liquidity mining rewards, and that also increases the chances of your order being filled and you capturing a profit. So, and this variable is determined by the anti-hysteresis duration, which actually says like, after how many seconds do you want to check if there's a better order available in the order book, if you're better off canceling the order and placing it at a better level. So those are the two things that happen every tick. And there's one other event, which is the order fill event, that happens at every, whenever there's an order fill. So when your maker order is being filled. And what is important to understand is that we'll first check if this order was created by the strategy. Then it will calculate the order size, and the order size is dependent on one variable, which is the order size taker volume factor, which I always have to 100%. And this basically means that if like 100 tokens are being filled on the maker exchange, how much of that do you want to hedge on the taker exchange? If you set 90, then only 90 of those tokens is the order size gets hedged. But I always set it to 100 because I want to trade fully delta neutral. And it's also important to understand that it is not that your taker price is not determined by your maker price. And what I mean with that is like the earlier observed taker price, the effective hedging price, is not always still the price where you can effectively hedge your order at. So if your maker order is filled, the bot will go over the order book and check like, what price can I fully fill the order now? And it will place an order. But what can happen in the split second that you calculate what the price is that you need to hedge your order at, it could be that other cross-exchange market maker traders, whatever traders already have taken those prices, the price has moved. So in this case, profit is kind of expected, but it's not guaranteed because the price could already have been moved, which causes like execution risk. So it's, I would say that it's not a set and forget strategy where every time a maker order is being filled, you just expect to have a profit. It could also be that it would be with a loss if the price has already moved too far. So now we know a little bit about the inner workings, like how does it work behind under the hood. We'll go into like some key considerations when you actually want to start your strategy. We'll go over like market spread, how you pick your markets, which is determined by the market maker spread, your taker spread. Order book depth is really important. And of course, you take into account the maker and taker fees and exchange latency. I'll mainly go over the first three, like how do you actually pick your markets? And of course, it's also important to, when you're starting your strategy, take into account execution, how well is it, and your overall profit and loss based on your trading, but also the reward you gain. But for now, I'll go over the first three parts, which is how do you actually pick your markets. How I do this, and I wish there are like some backtesting engines for this or some scanners which help me to do this. But for now, it's kind of manual work. Every time there's a token that I find interesting, for example, Lux on the Sendex, I go to CoinGecko, I go to the markets tab for that token, and I'll see a whole list of all the exchanges that this token is listed on. And there are a couple of things that I actually look at, which is generally the spread here on these exchanges. And this is all a snapshot, and then the plus 2% depth on these exchanges. And what this tells you is like from the mid price and plus 2%, how much volume actually in between that. And that basically tells you a little bit about the order book depth. And I will go into more detail about this later, why this is important. And then also you have the minus 2% depth.
Hey,
so first
sorry, back to that table. Question, do you hedge your inventory? Because like this one, it looks like it's down 39% when you took this snapshot. Do you actually look for markets where you hedge inventory, or is this one that you just take open risk on?
Good question. I think I have like 90% of my portfolios hedged. So I mainly only do it on tokens which I can either borrow or hedge with perpetual. And Lux Rare was one of the I could hedge it on FTX, I think, but it was a big funding rate, but it was still okay to be profitable.
Do you ever pseudo hedge due to the correlation between Ethereum, meaning if it's tied close enough, do you just short ETH?
I have thought about it, but what I see is that there are a lot of tokens which you can borrow on Gate.io, And generally, the tokens that you can borrow on Gate.io or you can directly hedge with perpetuals are really illiquid tokens. And I'm doubtful if they have a high correlation with Ethereum or something. And I have thought about it because, you know, that would open up a lot more opportunities for me, because there are a lot more markets that I can market make on. But for now, I'm just keeping it with the ones I can actually borrow, or I want to hold myself. There are some tokens that I'm okay holding because I fundamentally believe in what they do.
Right.
But
some of our market makers have told us that basically if they're market making for, like, say 10 different tokens, like maybe they're new launches or whatever, that they will, if they blend them all together, that there's generally like an 80% correlation with ETH. And so basically they'll just take the total basket that they're long of those and then short that amount of ETH and just accept that 20% delta, you know, as being as close as you can, and that allows them to actually sell those services and be in those markets, and then they just price in that 20% delta. So
yeah, I've thought about it as well. I looked at, I wanted to look at like a co-integration or a correlation scanner, which basically
And what they've said is that what they've said is if you look at it one by one, then you won't necessarily find it. But if you blend, like, and this is why it might apply to people who are interested in liquidity mining, is if you want to spread out over, say, 10 different campaigns on newer tokens, if you blend those together and then do the correlation calculation, you at least what our market makers tell us is you'll find that they're, you know, they'll average each other out, and you can therefore be more hedge, or, you know, at least some kind of hedge in place.
Yeah, true. I also thought about, on FTX you have these indexes on like a large cap or small cap, mid caps. I thought about hedging with those as well, instead of with ETH, for example. But I'll have to look into this. It's something that I haven't had time to actually experiment with, because there always have been enough tokens that I could actually hedge with. So again, this is a really handy tool for me, which I do most of my research on, of which markets I use as my maker and my taker exchange. So to quickly understand why a spread is really important, what you generally want to have is a maker exchange with a wide spread and a taker exchange with a tight spread. Because what this does, and I have an example here for Lux, for example, like this campaign is active on Ascendex, and it's generally a wide spread. You can hedge it on Gate, for example, which has a tight spread, and you can hedge it on this exchange as well, which also has a wide spread. So let's say that I use Ascendex as my maker exchange in this example, and I use this last exchange as my taker exchange, which also has a wide spread. What will happen is the bot will observe at what price can I, in this case, buy my asset at on the taker exchange. And this is pretty high because that's for the top taker ask price here. And then we'll place my order a specific minimal profitability level away from that price, which, let's say 0.5%. And then it will place the order at $100.90. But let's say you have a more liquid exchange, an exchange with a tighter spread, which could be the Gate.io, for example. It will observe, you know, at what price can I buy the asset at instantaneously. And that's at this price, which is way lower than the price here. And we have the same maker spread in this case. If it then wants to place an order at a specific minimal profitability level away, it will place the order way closer to the mid price, which increases your liquidity mining rewards, but also increases the chance of your order being filled and you capturing a profit in that case. So if you have a wide spread on your taker exchange, generally speaking, it will result in wider spreads on your maker exchange when your maker orders. So generally you want to choose a maker exchange with a wide spread and the taker exchange with a tight spread. But there's something that I've also observed with some pairs, and I've tested it out a couple times. Like sometimes it's okay to have a taker exchange with also a decently wide spread, because in previous situations we've always, you know, showed the taker spread to be like centered within the maker spread, like right here, right in the middle. But what sometimes happens is there are a prolonged period of times where this taker price, with a decently wide spread, just shifts a little bit down in a way that, you know, the price which you can buy at is decent compared to the other situation here. And if you then add like the minimal profitability target away, you're still able to have a decent spread on this exchange. This sometimes happens for a prolonged period of time, so you can still generate liquidity mining rewards, or you can, money because there's an arbitrage opportunity, for example. I have to say this is less common. Of course, this is a way better situation, which in generally allows you to have more profit and generate more liquidity mining rewards. But I would definitely say, like, if you're starting out, try and experiment with different kinds of pairs and see what it does and how the bot behaves, because sometimes there are pairs that are actually working this way. Because another thing that could happen is because cross-exchange market making is a mix between like pure market making and also an arbitrage strategy, it could still be that there are some like dislocations within the market. So let's say your taker market price shifts significantly downwards. That means that your top taker ask is here. If it then places an order on the maker exchange, your maker ask order is already better than the top maker bid order, and then it will automatically be filled. So you're capturing that arbitrage opportunity in that case. So that's also something that happens. I think this doesn't happen a lot. I think this is more for pure arbitrage traders, the opportunity, because they're a bit quicker than cross-exchange market making traders in general. But this is something that in really illiquid markets, definitely something that could happen. But like I said, this of course is a way better situation than having a taker exchange with a wide spread. Another thing that I take into account is not only spread, but also take into account the +2 and the -2% depth. And what this basically means, how you can see this is for this pair, for example, fine USDT, there's between the mid price and +2% of that price, there's around like $1,400 of liquidity in there. Let's say I use this on my taker exchange. If I want to place an order, which is like $1,400 on the taker exchange to buy my asset at, that means I would probably move the price like 2%. And opposite, if I would sell my asset for like $1,300 total worth, I would probably push the price down with 2%. And this order book depth here also has significant impact on how you pick your markets, but also how large of an order size can you actually do with this cross-exchange market making. And I have two examples here. One example here is a maker exchange, generally a wide spread, and a taker exchange with generally a tight spread. Let me go to the correct one. A tight spread, but very low, very illiquid market. There's not a lot of order book depth this one. And on the other side, I have an exchange which has the same maker market, the same spread in this case, but a way deeper and way more liquid order book here. And what will happen is, let's say I have a decent order size of like $600 on these exchanges or $700. The bot will observe like, what is my average fill price or the effective hedging price if I want to buy my asset on this taker exchange. And what it will do is, because the order is quite big, quite large that I'm placing, my effective hedging price will move up because it needs to fill all these orders. It will have a lot of slippage, etc. And of course, because the effective hedging price is higher in that case, and I have a specific minimal profitability amount target, it will place the order further away from the mid price on my maker exchange, which decreases my liquidity mining rewards, but also decreases the chance of my order being filled in that case. On the opposite side, I have my maker, the other situation in which the order book depth is way more, more liquid. And if I want to hedge the same order size on this exchange, it means that there's way less slippage, which means that my effective hedging price is lower if I want to buy on the taker exchange and placing sell orders, which is maybe more beneficial, which causes with the same minimal profitability target, which causes my maker order to be placed closer to the mid price, increase liquidity mining rewards, and also, increases the chance of my order being filled with a profit in that case. So you also want to take into account not only the spread, but also the order book depth, which is really important. And there are two things you can do. You can either, of course, choose a market with a deeper order book, or you can just decrease your size so there's less slippage, and this effect that is just illustrated is less common. When selecting your market,
actually, is there a question on or comment on the chat?
I see.
Okay. Yeah. So we will make this recording available. I believe we usually. I think we might post this to YouTube. We'll edit it.
I must say, it might be quite overwhelming, this whole strategy, maybe also this presentation, but the basic concept and the parameters to tune are quite limited. So this is a lot of like background, like how does the strategy actually work? But if you actually want to set it up, the most important thing is like picking the markets, which you have to select by the spread and the order book depth, and then tuning the parameters, which I'll go into in a little bit. The main risks for the strategy are mainly execution risk, which I would define as not being able to hedge your order at the desired price, so the effective hedging price that you earlier defined, or not hedge at all. And what I also observed, this is mainly caused because if your order is being filled on your maker exchange, there might be other cross-exchange market makers fighting for the same taker price, which means that there's more slippage, which could mean that you're not hedging for your effective hedging price, but actually hedging for a less beneficial price, etc. A couple of things you can do: you can increase the slippage buffer to make sure that to increase the chance of your order being filled, or you can add a top depth tolerance taker, which is a parameter that I've included, which accounts for more size than you're actually placing the order at, which leaves more room for error. And the second thing is inventory risks, which is, let's say your maker order is being filled, you buy, but we're not able to sell the asset on the taker exchange for whatever reason. This means that you just increase your position into an asset, and if the price goes down, that means you're effectively losing money, or you're trading a negative delta P&L. So what I have included, and this is something that I will go into in the end, is a balance fixture which restores my balance to a specific target balance, and I'll talk about this a little bit later. So when you're starting your strategy, there are a couple parameters that you can actually tune. A lot of them I actually just leave at the default settings. There are a couple of things I actually change. First thing you need to define is your minimal profitability level. And as a rule of thumb, what I use is my taker fee, my maker fee, plus my slippage buffer, plus a specific profit that I have in mind. So let's say my maker fee is 0.1%, and my taker fee is also 0.1%, and I have a slippage buffer of 0.2%. That means my minimal profitability level should at least be 0.4. And then I add like maybe 0.1% or a little bit more to, increase my profits a little bit. And secondly, I changed the anti-hysteresis duration to 10 to 20 seconds. So what I talked about previously is like every 10 or 60 or 20 seconds, whatever you define this parameter at, it will check whether there's a better maker price available. Like I talked about, if you're placing a maker sell order, price move down, you're better off canceling the order and replacing the order at a better level. It does this every 10 or 20 seconds. Now, secondly, I add a slippage buffer. And what a slippage buffer effectively does, it will allow for more liquidity in the taker order book. It can take more of that liquidity to actually fill your order. So instead of placing the order at the effective hedging price, it will place the order at the effective hedging price, basically plus 0.2% or a little bit more deeper in the order book. And it's important to understand that it doesn't matter for your profitability whether you set this parameter to 0.2 or, for example, 1% or 2% or maybe 3%, because if you want to buy on the taker exchange, it will just push the price at which it wants to buy even lower. So that basically means that it will act as a maker order, like you're just buying for whatever the available price is, basically. That also means that as you're increasing this parameter, it could also mean that you can trade at a higher loss, because it allows you to buy an asset or sell an asset at a less beneficial price. And then lastly, I changed the order size taker balance factor to like between 97 and 99%. And what this basically means is that if I have $100 USDT on my taker exchange, and I set this parameter to 50%, that means it will only allow 50%, 50 USDT of that funds to be used for hedging. And so you leave a little bit of extra room for error with this parameter. Any questions so far?
I do have a question, sorry for the interruption.
Yes. Go ahead.
In general, when you are trading, do you let the same strategy rebalance your account or your assets by doing the opposite operations that to the ones that have been executed more frequently, or do you take manual measures to rebalance your positions?
You mean in situations where you have execution errors? So I'm buying an asset and was not able to sell the asset, so I increase my position. Is that what you mean?
No, I'm more interested on the scenario where you might be executing more buys on one market and sell on the others, and at some point you don't have any more balance to keep doing that, right? So
good. Yeah. A good question. Yeah, this is kind of like a misconception that I hear from other traders as well, that you have to send funds from one exchange to the other one. So let's say I only have AVAX on my maker exchange and only USDT on my taker exchange. It will only place maker sell orders and no maker buy orders. And once these sell orders are filled, I buy on my taker exchange, and then I will only be placing buy orders on my maker exchange until these buy orders are filled. So it goes like from only placing buy orders to only placing sell orders. And it will rebalance like on and off. You know what I mean?
yeah, okay. So you let the strategy rebalance itself.
Yeah,
basically.
yeah,
okay.
yeah. I don't move funds around.
Okay. Thank you for the answer.
And what I really like about this strategy is that I can really scale my strategies. That's because I can run this next to my pure market making strategies that I'm running, or Evelinator strategies. I can run a cross exchange market making strategy. I can scale across exchanges because I can use multiple taker exchanges if I set up multiple strategies. So let's say I market make on these HMT USDT, and for one strategy I use Bitfinex as my taker exchange. For another strategy I also use FTX for my taker exchange, and for another strategy I use another exchange that is available. So you can really scale up the funds per campaign that you're running this strategy on, next to maybe running it for a pure market making strategy. And then also, and this is, builds a little bit on top of the improvement proposal that I'm gonna propose, is you could also technically scale across quote pairs, because in theory you should be able to also market make on an HMT USDT, but hedge on HMT ETH basically. If you take into account the conversion of ETH USDT, and I'll talk about this a little bit later. So there are 3 ways to actually scale up with cross exchange market making, with adding more strategies, multiple exchanges, and maybe across quote pairs as well. And to sum it up before we're almost done, a little bit the pros and cons of the strategy. So the pros mainly are that all trades are designed to be profitable. For pure market making, this is not always the case, because you could also buy high and sell low depending on what the market is doing. And generally all trades are designed to be profitable for cross exchange market making. It's scalable on order size. You can what I generally do is my order size are almost 100% of my available balance. While for pure market making, you maybe place orders which are maybe 30 or 40% of your balance, because then maybe if you're buying more, you're not buying everything, and if you're selling, you're not selling everything at one point. It's really scalable in taker exchanges and quote pairs, which I just explained. And the thing that I really like is with pure market making, people tend to, for example, if there's an uptrend, widen their ask spread, for example, because you kind of need to have a little bit of an understanding of where the market is going and adjust your bot to it. But for cross exchange market making, it really doesn't matter where a market is going, because the spread really adapts to the taker exchange and wherever the price is going. So it's really nice to have that. You don't have a lot of inventory risk because you're always buying and selling at the same time in theory. But as I talked about before, this is not really always the case, because there's also some execution error. And it's really easy to hedge, because in theory, you would always have the same base asset because you're buying and selling at the same time. You're trading delta neutral. So you can easily hedge your funds on a perpetual exchange by short selling, or you can borrow tokens and then use those tokens to market make on a specific exchange. You also help increase markets, keep markets efficient, because you make sure that prices are closely connected together, which is important, and you can easily combine strategies. Some of the cons to summarize this is you're really dependent on a taker exchange and the spread of this taker exchange. Therefore, it's not really applicable for all pairs, especially the Ascendix pairs is sometimes hard because there is not really a taker exchange that you can use to hedge your asset at. There's definitely execution risks, which means that your taker order is not always filled at the desired price or not filled at all, which increases inventory risk. I would also say that in general, cross-exchange market making is less capital efficient. And this is because you need double the funds. Because if you're selling, if you have all your AFAX on your maker exchange, you also need the same amount in dollar values on your taker exchange that you're not placing orders for. You're not market making with that. So you need almost double the funds compared to a pure market making strategy. But on the other side, you can also place orders which are almost 100% of your order size. Generally, I also observe that the spreads that you're placing your orders at are generally a bit wider than for pure market making strategies, of course, depending on your risk factor. And you generally tend to set one-sided orders because at one point, all your assets on your maker exchange are being sold or being bought back. And then you have all your assets, your base assets on your taker exchange. And this goes on and on, for example. So mainly one-sided orders instead of two-sided orders, which also could decrease liquidity mining rewards because the rewards are split between bid and ask spreads, basically. Before I go into the improvement proposal that I quickly wanted to talk about, are there any questions about the strategy, things that you want me to elaborate a little bit more on, etc.?
I have one more question. I'm not sure it's strictly related to what you have mentioned, but I was curious, did you have at any moment the idea or maybe believe that it would be beneficial to do cross-exchange market making by using two perpetual markets?
Yeah, I have thought about it, and I actually I've said this in an issue before, or I have mentioned this on Discord before. It's way more efficient to use a perpetual market as your taker exchange because you can use leverage, and therefore you don't need double the funds. But yeah, I think it's a really good one to use the perpetual exchange as, for example, your taker exchange, because then you're also hedging your funds at the same time.
And I think the other benefit is that in general for perpetual, you don't need to have all the tokens, right? You can have the base token.
And I think that would be really nice if that's possible in the future. And also the fees in general for perpetual exchanges are lower than for spot exchanges, for spot pairs. So it would be beneficial to do. Also on the other side, a lot of AFAC, Ascendix tokens or campaigns don't have a perpetual market, so that would not be possible. Any other questions for now? I'm not able.
Sorry. What I don't know if I am speaking on top of other person here, but using cross-exchange market making, have you seen any problem or lack of or losing a benefit since you are using maker orders in one of the markets? So if you are using taker orders in both of them, you could be maybe participating in two campaigns at the same time, right?
Yes and no, because you're placing maker orders on the maker exchange, but the taker order on your taker exchange is filled instantaneously. Like there's a split second in between the order filled on your maker exchange and the order being filled on your taker exchange. So this limit order on the taker exchange is not in the order book for very long or not at all. So you can earn liquidity mining rewards from that pair.
Okay, I get it. Yeah, thank you.
Well, what I have done before is I think it was on high USDT. I used one strategy in which I used Gate as my maker exchange and KuCoin as my taker. And there was also a campaign on the other side. So I also run a strategy which was the opposite. So I used KuCoin as my maker and Gate as my taker, for example. And that is possible, even though the spread was quite similar.
So you sold, in that case, you sold it. You participated in both campaigns by having two bots running the opposite strategy in each other. Let's say. Yeah. Okay.
I did it, but it's important that you need to run it on a sub account then in that case, because otherwise, you'll not have enough available funds depending on your order size. But it is possible.
I see. Yeah. Thank you.
Yes. I have another question in the chat. It said, is it possible to use borrowing instead of perpetual when perpetual is not available at all? Yes, I do this mainly on Gate.io. You can also do margin trading, in which you do automatically margin borrowing at the same time. I mainly just borrow the asset and then use that to run the strategies on. And then when I'm done, I just return the tokens that I've borrowed. Okay, then I'll quickly go into the improvement proposal that I have written and will probably post like next week. So I've implemented this already. It's working quite well. So there's two things that I have is, first of all, a balance fixer. So I talked about before is that sometimes when there's some execution error for whatever reason, your buy order is filled on your maker exchange, but you, for some reason, couldn't fill your taker order on your taker exchange, which means that you're increasing or decreasing your position. And what it does then is like, I define a target base balance. And once this, my total base balance deviates from this target base balance for longer than a specific amount, let's say a minute or for 3 seconds, my balance is automatically restored. And what this does is it reduces the cost of execution risk, because instead of manually rebalancing your portfolio after maybe an hour after it happened, because you're in front of the terminal, you can do it automatically, which also allows me to just run all the strategies almost on autopilot, because once there's an error or an execution error, it just fixes itself, which is really nice. Instead of me having to find it out manually by looking at the exchange, going into the exchange and manually buying or selling an asset to get it back to my preferred target balance. For me, this is done automatically now, and I think will be a big improvement to the strategy. And another big one is cross-exchange market making in a triangular arbitrage way. Like I talked about before, you could run your strategy in which you have a BTC or ETH denominated pair as your taker or maker exchange, but then use a USDT denominated pair as your maker or taker exchange. So an example is, let's say I use my maker exchange is Binance AFEX BTC, and my taker exchange is Binance AFEX USDT. The current price is for AFEX BTC is here, and you also have the current price for AFEX USDT and the current price for Bitcoin. So what I will do, the bot will observe like, what is my taker price? What is the price I can effectively hedge my asset at in AFEX USDT, and then convert it to a AFEX BTC pair. So I'll do this here. So then you'll get the AFEX in BTC terms based on the BTC price at that point. And then it will place a maker order, which is a specific minimal profitability target away from this price that you've just calculated. And once this AFEX BTC maker order is filled, let's say your sell order is filled, your AFEX sell order, that means you've just increased your BTC position because you sold your AFEX for BTC. That means you'll buy the same amount of AFEX on your taker exchange. And at the same time, you're also returning your BTC or selling your BTC that you've just increased your position in. So there's 3 trades that are happening. First, your AFEX BTC, then you buy or sell your AFEX for USDT, and then you also make sure you increase or decrease your BTC exposure to effectively trade delta neutral again. And this is all possible, and what this really allowed me to is to also easily run strategies for ETH or BTC denominated pairs, which is really nice because generally the liquidity on those pairs or the yield on those pairs was quite high. And also this allows me to use more taker exchanges because I can also use AFEX BTC as my taker exchange and run the strategy on AFEX USDT or other strategies. And I think that's it. So yeah, I got my handle here. If you guys want to chat about some stuff, talk about strategies, etc., feel free to hit me up if you have any more questions. And if there are any more questions now, feel free to post them in the chat or just speak up.
Yeah, thanks so much for doing this. You know, one of the things that makes the Hummingbot community really unique is market makers are traditionally very secretive about how they run things and set things, and we love this attitude of sharing. There's money to be made for everybody in lots of different markets, and so I really appreciate you putting this together.
Any other more questions? Let me check the chat real quick. I think that's it. Then I wish everyone a great weekend. And let's hope the crypto markets go the other way around from here. I don't know if anyone had Luna, but I feel sorry for them. I hope you still have a great weekend, and we'll talk soon.